Hello students, welcome to the lecture. In the previous video, we have started a chapter called Time Value of Money, and we have completed simple interest, and we were doing some sums with respect to compound interest. We had completed the concept of compound interest. The two problems that is remain of compound interest is problem number 2 and problem number 3. So I hope you have practiced the simple interest questions and the previous question that we have discussed, that also. Okay, and the notes will be provided very soon because there is some work which is pending. So after that, I'll be providing the notes within a week. Okay, so right now you can revise from this lecture again by viewing that again and by making the notes in the lecture. Okay, let's start with problem number 2. It says a company offers an FD fixed deposit scheme whereby 10,000, this is your principal, matures to 12,625 after 2 years on a half yearly compounding basis. So here your N will be 4. Okay, your N will be 4, that is 2 into 2, that will be 4. Okay, and if the company wishes to amend the scheme, it's giving us a scenario that if company wants to amend the scheme and want to make it quarterly, okay, in a compounding interest quarterly, then what will be the revised value? So quarterly, if it will be quarterly, then L will become 2 into 1 second. This is the figures in case of half yearly. Okay. And we need to find out the amount in case of quarterly. So in that case, the N will become 2 into 4 because there are 4 quarters in a year. So N will become 8. But to find this out, first of all, I need the rate of interest. So to calculate this, first, let's write down the formula of compound interest. Our formula is amount is equal to P into 1 plus R to the power N. Okay. Here, the formula becomes 12,625 is equal to 10,000 1 plus R upon 100 to the power 4. So, we'll get this thing here. Okay. 1 plus R to the power 4. Now, the value of this is equal to 1.2625. Now, how will you find out from this? The maths calculation that we have, that we will take the square root of this particular number, that is a very big calculation. The shortcut we have is we can refer the table which is called as, 1 second, let me show it to you. This table is called as compounded value of a given amount. Which is called as CVF. R, that is your rate of interest. N, that is your number of years or number for the period which we are seeing. So the N we have is 4. Okay, and we have a value called 1.262. So what I am getting here, this is 4 and this is 6, and the value I'm getting here is almost exactly the same, 1.262. So this R I come to know so easily that this R is 6%, but this is not annually, this is for half yearly. Okay, so to find it out for annually, it will become R is equal to 6 into 2, that is 12% per annum. Why I had multiplied with 2? Because this was for half yearly. I had converted it from half yearly to annually. Okay. Now, I got my rate of interest. Now what I need to find out is the amount in case it compounds quarterly. In that case, what will be my amount? So in that case, let me calculate this for you in a better manner. Let's start with the formula. A is equal to P plus 1 by 1 plus R to the power n. Principal was 10,000. Interest is 1 plus R. What is R? Again, now here the R will equal to 12 by 4. That is this rate of interest for a quarter. So it will be 3%. So it will be 1 by plus 3 by 100 to the power 2 into 4. Okay. 1 plus, you can say 1.03 to the power 8 into 10,000. Now to solve it, either you can choose the calculator method that we have learned yesterday. I will repeat it again. This is my calculator. Okay. I'll be writing, it's 8 times, so we have to be careful. 10,000. Okay. We'll click on plus. Then we'll have 3. Okay. Then we'll have percent. This is for 1 year. 1 period. Okay. Now plus 3 again percent for second period. Likewise, I'll do this 8 times. Third time, fourth time, fifth time, sixth time, seventh time, eighth time. Value I got is 12667.70. 12667.70. This is the one method. The other method that we have, that is also very simple, more simple than this one, is to go through tables. Okay. So, I want you to learn this table. If it is given to you in your examination, there are chances that it will be given to you in the examination. Now, we have 3%, okay, and the n that I have is basically 8. So, the value is 1.267. Let me check. If I do it as 1.267 into 10,000, from the table I have done, from table. Okay. So what value I will get? 12670. So it's almost the same. Okay. So this much approximation is okay while you are doing compounding. So basically, you can choose either of the method. If you are given this value in the question, or you have been given the this table in your examination, then it is faster method to choose as compared to calculator. Okay. Now we have some one more problem, that is problem number 3, that is a nationalized bank issues reinvestment certificates, okay, for a period of 3 years. Okay, so your N is 3, and if the amount that was invested is 5,000 and their maturity value is 6,000, will become 6,725. Assume the interest is compounded every year. What will be the rate of interest? Now again, note the things which is given. Principal 5,000, amount 6,725, N is 3 years, and this annually. What we need to find out is the rate of interest. Write down the formula first. $6,725 is equal to 5,000 bracket 1 plus R to the upon 100 to the power 3. Now similarly we are getting this 6,725 upon 5,000 1 plus R to the power 3. Okay, so the value that I am getting here is 6,725 divided by 5,000, that is 1.345. Now again we need to see the table for this. Let me open this. My again my N is 3 and my value is 1.345. So N is 3, okay, value is 1.345. So you can see here for number 3 in front of N 3 in 10% we have 1.331 and we have 1.345. So it will be more than 10, but you can see N3 and 11%, for 11% it is 1.368. So it is in between that. So I can clearly say that it is in between 10 to 11%. Between 10 to 11% my rate of interest. Now how will I find the exact one? So now I need to do the trial and error method. That is, we got 1 plus R to the power 3 is equal to 1.345. Now put the 10% here. Solve this. $1.331. I'm getting this. Okay. So it's around, means I can write as 10% approx. My answer. Okay. Now let me check I'm right or not. So yes, rate of interest is 10%. So itna approximation chalta hai. There is no issue with that. Okay. So you can note this down. Okay. I'll give you a minute. You can pause this and note it. Done? Okay. Now we'll start with next topic, that is effective rate of interest. Okay. So Now the effective rate of interest means it is the actual equivalent annual rate of interest at which the investment grows in value when interest is credited more than once a year, and if the interest is paid m times in a year. So the formula is this. Now just let me explain it to you. Suppose you have taken a certain policy where you are getting interest received on quarterly basis. That is, you are receiving 4 times in a year. So how much interest you are receiving annually, that is, what is your actual rate of interest that you are receiving, is known as effective rate of interest. So the formula for effective rate of interest is 1 plus 1 upon m to the power m minus 1. Now m is the interest received, the number of times you receive the interest. Okay, so if you have received interest 4 times, then m will be 4. If you have received 6 times, m will be 6. Sorry. So that way. So we have one question to practice here. Suppose, for example, if your interest is 10% and is payable quarterly, what will be the effective rate of interest? Your interest is 10% and you are getting it quarterly. Now calculate the effective rate of interest. Then it will be 1 plus 1 upon m to the power m minus 1. Okay. Actually, it's r upon m. It's wrongly mentioned. So my rate of interest is 0.1. I'm receiving it 4 times to the power 4 minus 1. So again 0.1, 4.1 divided by 4, 1.025 to the power 4 minus 1. That is 10.38, or you can say 0.1038, that is 10.38%. So that is my effective rate of interest. Okay. Do the correction in the formula, okay. Now we can note this down. You can pause this and note it, okay. Now the next topic that we have is future value. How to find out the future value. So this is what basically we were doing actually right now from by calculating simple interest or compound, basically mainly by calculating compound interest. For example, if I invested rupees 1 lakh today, okay, what will be the value of this 1 lakh after 1 year? So to find this value out is basically future value. This is your present value. Okay, so the future value formula is basically the present value, or you can say the principal 1 plus I, okay, 1 plus I to the power n. N is the period for which you have invested, and I is basically the rate of interest upon K. K is like if you have been basically compounded the value quarterly or half yearly. Accordingly, if it is quarterly, then the K will be 4. If it is half yearly, then K will be 2. Okay. So this is the formula, and this can be calculated by using either calculator or table. So the 3 examples we have done is basically we were finding the future value of the amounts that are invested. Let us see those questions again. Now, okay, one more thing, that this is the future value factor, this, okay, that we have seen from the table, that is known as compound value factor, or it can be called as future value factor, the same table. This table. See, it is mentioned compound value of a given amount. So this value, these tables, we're going to refer to find out the future value, and how we have to see this, I'd already told you. Okay. Now let us again see those questions that we have already did. Okay, I'm not going to provide the solution once again, but just I am going to provide you basically the idea that what was the future value in that. Okay, and also note this N is basically your number of years, okay, or the number of period. If it is like, if suppose number of year is 2 and your it is compounded quarterly, then it will be 2 will be multiplied by 4, then it will be N will become 8. Okay, 2 into 4, 8. See, here in problem number 1, 2000 is your present value, and what is the amount? So the amount that we have actually calculated is basically the future value that we have calculated for the 2000 rupees. Okay. And the next problem, when a company offers an FD schemes in which you are investing 10,000 and your value will become 12,625. So this is the future value and this is the present value. And again, same in the question number 3. Okay? Same is the case in the question number 3. Okay, so I'm giving you a minute time. You can pause the video and just go back to those questions and have a look on them again. Okay, or you can like pause the video here and read the question again. Okay. Now, we'll be moving towards next topic, that is present value. Right now, till now we were calculating future value, okay, from the present value or from the principal that we have. But now we'll be calculating present value from the future amount. Suppose we have a requirement that we need a rupees 2 lakh after a period of 2 years or 1 lakh after a period of 1 year. So to get that 1 lakh, how much amount I need to invest today is basically the question that arises in our mind. Okay. So to answer that question, this particular topic comes up. Okay. Where it basically tells you or taught you to calculate the present value of the future amount that you want, that you need. Okay. So what it says that it is a current value of future amount, it also be defined as the amount, what amount you should be invest today to give the rate over a specified period equals to equal the future amount. So how much I need to invest today so that I can obtain the desired amount that I need after a period of 1 year. Okay. So since finding present value is simply reversing the future value formula, okay, so you can see this, okay, the formula that we got here is basically the present value. Okay, we have seen the formula right now. One second. This formula. So this was the present value actually. Okay. So to convert it and to find out present value of for this is equal to future value upon 1 plus I to the power n. Now you would be thinking that it would be a very tough calculation, but again we have some short trick. Okay, I'm providing some short trick using calculators that will going to help you and fasten your calculations. Now what it says, future value of n years upon 1 plus I, that is rate of interest per annum, and n is number of years. Now the computation of present value will be quite simple by using calculator, and similarly we have present value tables that, as we have seen the compounded value factor table, we have present value factor table as well. Okay, I'm going to teach you in both the ways, and the process of calculating the future cash flows, the present value of the future cash flows, is basically called as discounting. Okay, and the rate of interest at which that discounting is done is basically called as discount rate. Okay, and the expression 1 upon 1 plus I to the power n is called as discounting factor. Let us see one problem. It says the cost of new mobile phone is 10,000. If the interest rate is 5%, how would you set aside now to provide this sum in 5 years? So means you need 10,000 rupees after a period of 5 years, and the interest rate is 5%. So how are you going to calculate this amount? How much amount you need to put today as an investment to get an amount of 10,000 rupees after 5 years? So your future value is 10,000. Your rate of interest is 5%. Okay. And you need to find out the present value. And your n is 5 years. We have the formula present value is equal to future value upon 1 plus I to the power n, which is equal to 10,000 upon 1 plus 5 by 100 or 0.05, you can do it. Okay, to the power 5. Okay. Now this amount is actually become future value into 1 plus I to the power minus n, that is 10,000 into 1.05 to the power minus 5. Now how to calculate this value, I'm going to teach you in calculator right now. What you have to do is press 1, then press divide, then press 1.05. Okay, 1 second. I need to calculate 1.05 to the power minus 5. So what will I do? I will press 1, then I will press divide button, then I will press 5, then I will press sorry. First I'll press 1, then I'll press divide button. Then I will write 1.05. Then I will press equal to, okay, this. This is the value you are getting for the year 1. So my n is 5, okay. So I need to press this 5 times. I have already pressed it for 1 time. So it will be 2, 3, 4, 5. What amount I get? 2, 3, 4, 5. Now I'm getting the amount. The amount I get is 0.7835. Okay. Now, this amount I got, calculating it here, okay. 10,000 into 0.7835, or simply multiplying it directly by 10,000. Value I'm getting is 7835.26 rupees. So this is the present value that I need to invest today to basically get the future value as 10,000. Okay. So this is very simple. Now similar question we have problem number 2 of assignment problem. So that is your homework. Okay. Let's start with next topic, that is calculation of amount of annuity or future value of annuity immediate. That is, suppose annually you want to invest certain sum. Suppose, your annual saving is 1 lakh rupees and you want to save this 1 lakh every year. So you want to find out that after a period of 10 years, 20 years, okay, after a fixed period of time, how much amount you will be receiving as your future value. So, what do you mean by annuity is annual payment, okay. Annuity means annual payment, like you give it in LIC premiums or your health insurance premiums. So, all these premiums kind of thing that you pay for your, for your car insurance, for your health insurance, for your life insurance, these are called as annuity, okay. So let us see what is written here. It says annuity is a stream of regular periodic payment. So it is the regular periodic payment which is made for a specific period of time, and in an ordinary annuity, payment is generally occur at the end of such periods, that is at the end of year 1. So like if the year is from January to December, then your premium will be charged on 31st December, okay. So at the end of the year. And the interval is generally the year, but it may be half year, quarterly or monthly. It can be like that, but generally it is yearly, okay. And in fact, annuity actually means an installment like LIC premium, deposit in your RD account, recurring deposit account, okay, and loan installments of homes or automobiles. These are some examples of annuities. And now there are certain terms that you should know, that is, what is periodic payment? That is the size of each payment of an annuity, okay. And now, if suppose between two successive payments, you have a gap of a year, so that basically time interval between two successive payment date is called as payment period or payment intervals, okay. Now the total time period is called term of annuity, and an annuity which is payable forever. There are certain policies that you know that runs for 99 years or that runs for forever till you are alive, or even after that also. So these are like called as perpetuity. The term for this kind of schemes, for this kind of annuity which is payable forever, is perpetuity. Okay, and present value of an annuity is equal to sum of present value of all installments. Let me explain this point to you. See, suppose you have taken a scheme where 1 lakh rupees is your annuity, which is to be invested every year, and the period for which it is to be invested is 5 years. Let's say rate of interest is 10%. So your cash flow is basically 10,000 year 1, year 2, okay, let it be 3 years, and year 3. Now we need to find out the present value factor. 1 lakh, sorry, it's 1 lakh. Now for 10%, again we'll be calculating. Now what I'm assuming here, that this payment is done at the end of the year. Now how we'll calculate this present value factor? Again I'm telling, 1, it is 100, 110, okay. So if I do it like 110 by 100, it will be 1.10, okay. So 1 divided by 1.1 equal to, so this is for the year 1, 0.909. Again press this. Now this is for the year 2, 0.826. Then again press it for the third time. It will be for the year third, 0.751. We'll take it up to 3 digit. Now when we'll multiply this cash flow into present value factor, we'll get the present value of these annuities. Okay, so it will be 1 lakh into 0.909, 90,900. Now next, 1 lakh into 0.826, this will be, present value will be 82,600. And for 1 lakh multiplied by 0.751, your present value is 75,100. Now we'll do the total of this. 8248,600. So this is basically the present value of annuity, which is sum of the present value, sum of present value of all installments. Okay. So basically, if you will be getting at least only 3 lakh rupees in return, so that will actually, the value of this 3 lakh rupees after the end of third year will be equivalent to 2,48,600 rupees. Okay. Or you can say the value of this 2,48,000 will basically value of 3 lakh after a period of 3 years will be equivalent to the 2,48,000 value at present year. Okay, so that is 3 lakh. The value of 3 lakh will decline after a period of 3 years. Now the total worth of all payment at the conclusion of annuity is called as amount of annuity. Okay, and accumulated sum of series of a periodic deposit invested for replacement of an asset or for liquidation of loan is called as sinking fund. What does this mean? Let us read this again. Accumulated sum of series of periodic deposits. So you have done periodic investment, okay? So the accumulated sum that you have, now you are using that sum for replacing your asset or for repaying your loan is called as sinking fund. When you are doing it for the purpose of replacement of an asset or for liquidation of loan, then this particular investment that you have done will be called as sinking fund. Now next is future value of an annuity. Okay, so right now we have just understand the term annuity. Now we need to calculate the future value of today's annuity. Okay, so what will be the future value of the amount of annuity is the sum of future values of each individual payment at the end of the each year. So like this, we have calculated the present value of, suppose you will be getting the cash flow yearly, you are receiving 1 lakh, 1 lakh, 1 lakh. So the present value of this 1 lakh that you will be receiving after 2 years will be this. Okay. So the actual thing that you will be receiving is basically this amount. But now we are considering future value. We have to calculate the future value. Means if I am investing, okay, and I need to do the payment, then what will be the future value of the annuity that I am today investing? Okay. So for that we will refer future value factor, annuity factor, or future value interest factor of an annuity. For this, again I am going to refer the table. The table is quite different here. Okay, so the formula we have future value of annuity, future value, this is your R, that is the yearly investment that you are making, into future value interest factor annuity. I is your interest, N is the period for which you have taken. Now again we'll be using the table here, or we can use a calculator like we have done it, like 10,000 in plus 10%. Okay, so 10,000 plus 10% plus 10% in that way. Okay, so that is how calculator will be used here. Now we'll be doing some sum. Okay, but right now just have some write some notes to your which is going to help you in solving the sum. First, it is assumed that each periodic payment is made at the end of each year. Okay, and the future value or the amount of annuity is the sum of future values of each individual payment. Now please note that the last payment is made at the end of nth year. Okay, so it will not yield any interest. So no interest will be charged on the last payment that is to be made. Now we have one problem in front of us. Okay, before starting this particular question, let me tell you one thing, that this table, compound value of annuity, is when it is used when we need to find out the future value of annuity. Okay, so and if I need to find out compound future value of a particular sum, then I need to see the table of compound value of a given amount. One second. Compound value of given amount is used when you have to find out future value of a specific amount. But when you have to find out future value of an annual installment, okay, an annuity, then you will be referring to this table, okay. Let me begin with this question. This is a quite big question. We'll be doing at least first part right now. Rest two part will be covered in next video. It says, first part says that Mr. X wishes to get her daughter admitted into a medical college after 15 years from now. So your N is 15 years and your R is, the amount that is required is 25 lakh. So actually the future value is already given, but we need to find out, he has been identified the fund where he'll be getting the rate of interest as, he'll need to pay, which will pay the interest as 9% per annum. So how much amount he need to be invested in case of following situation? The first situation is if he wants to make an annual payment into the fund at the end of each year. So this is your annuity. This is your annuity. Okay, this is your annuity. Now, in that case, how will we going to calculate this? We're going to use 25 lakh and we'll be dividing it by future value annuity factor for 15 years on for 5%. So again we'll be coming to this table. Now this is 9% and my N is 15. So this N is 15. This is 9%. So the value is 29.361. Now you can see this value is given in the question. Now we'll be dividing this 25 lakh, that is your future amount, divided by 29.361. This will give the amount that you need to invest annually, to get this amount in future. So I am dividing 25 lakh divided by 29.361. The answer will be 8,51,447. 85,147. So my answer is right. Okay. It is actually 46.96, but I'd convert. Okay. Now next is when we decide to invest a lump sum fund today. So now I'll be using for that given amount. So for that given amount, let me open the table. So you can see the percent is 15 and my N is also 9. Okay. Okay. And my N is 15 and the value is 3.642. Let me check with the thing. Yeah, it's 3.642. Now, we'll be dividing future value with that future value factor I and N. So we'll be dividing 25 lakh with 3.642 that we had find out. The value I got is 6,86,436.02 rupees. Let me check I am right or wrong. Yeah, this is the right. Now you can pause it and note it. We're going to cover the next part, the last part of this question in the next video. Till then, please revise it till here and we'll be covering the rest of the chapter in the next video. Okay. So please revise this lecture before moving towards next lecture. Thank you.